We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to talk about one of the most simplest measures of macro in the US economy. It's as simple as this. In finance, it's assets to debt. The US economy has huge debt, therefore the asset must be priced to accommodate debt. Assets of importance are stock market, the housing market. Now, income from assets is critical to the US Treasury, as income supports government spending. Poor income means government spending must be financed with debt. The ratio measure the health of the US economy is the SPY ETF divided by the TLT ETF, or S&P 500 stock index divided by long dated bonds, hence assets divided by debt. Now this ratio continues higher, the debt is safe and the risk is low. If the ratio goes low, then the assets are not supporting the debt. That's just a general background. Now let's have a look at the chart. So here we are with a analysis chart with the SPY divided by TLT. That's SPY : TLT. Now I have an indicator on here called RTT steps. So the price is the bars, and we have an indicator of trend and support and resistance called RTT steps. Generally, when this is rising, when the price of this ratio is rising, all is well with the assets to debt worry. When it starts to break down, the debt is a concern and risks grow. Here we have the sell-off in 2001, 2000 to 2003. That was primarily based on the Nasdaq popping and all the capital lost from that. Here we have the housing crisis, and now we're getting, some are calling this the everything bubble popping. Now the price down the side is interesting. See how I've got these numbers: 2.8, 2.6, 2.4, 2.2. That's the ratio of the SPY to the TLT. Now we go down here, I'll explain that before. Here's the SPY, it's currently around 247, and the TLT is around 170. So the ratio is currently 1.5. So that means the SPY ratio 240 to TLT 170. Okay. Now, what's important about the ratio is that, and with the RTT steps, it helps us to forecast. Now you can see here when price broke down, it went to near the low end of the range of RTT steps. Low end of the range of RTT steps. Actually had one step down, actually very, very strong bearish. And as you can see, when price stays above the dotted line, all is well. So as you should notice here, this massive warning here. See the massive warning? Is like here. This one was a higher low. This was an equal low. And we actually had some very dangerous points here, whereas you can see here, the points has actually been higher. So bonds were outperforming stocks for some time, and here we can see the bond market performing better than stocks. See, higher lows, we had higher lows here, but the ratio, bonds are moving quicker than stocks, and that's why bonds were outperforming stocks, and that was a warning. It was doing so here. Look, if you notice here, bonds were outperforming stocks here, but we didn't have a deep dive in retracements. See, it held up there. See, bonds were outperforming stock. Here's the SPY, and bonds were outperforming. That was the 2016. So 2016 there was a concern of a global slowdown, but I believe the story goes global slowdown warning, and then China did massive stimulus and it saved the world, and then obviously Trump got elected and there was massive stimulus with tax cuts. We've got it up here, right? So when we have sideways action, bonds and stocks are either equal or bonds could be outperforming. Unfortunately, what happened here is that the volatility was so strong and bonds got too powerful, and it reflected the current economic climate, and eventually asset prices broke. So let's use this as a forecasting tool. We'll just have a closer zoom in. Now what's interesting here are RTT steps. Our RTT steps is calculated by the average Q range. So it's based over a period of quarterly, so it's 6 bars, 2 quarters, right? And a factor of 2.5. And it forecasts future price action quite well. So at the moment, on a worst case scenario, we've got a forecast of a ratio of 1, and on the SPY divided by the TLT. So forecast ratio 1. For example, here price fell through here. It actually got to the lower end of the range quite quickly. So this was the continue to fall. I would believe support would be a ratio of 1. So where would that mean for stocks? So at the moment, TLT is about 170. Now obviously the 10 years at 0.6, so I have to take it close to 0. So let's say 180 on the TLT, and that would basically mean stocks around 180, which is here. Alright? That would take the ratio down to 1. So the stock market would have to fall further, which is quite dramatic. That's a worst case scenario. A better case scenario is 1.2, and stocks would fall, you know, a little bit higher up. If it was like 2008, the ratio got down to 0.8. See, 0.8. That would be pretty bad, because that means stocks would probably have to come all the way down to 140 on the SP 500, on the S&P 1400. There we go. So this is extreme, this is worst case, and this is moderate on the SP 500. Of course, that's on a bear case. If it holds on the current range here, this is SP 500. If this holds, because as you can see here, price on the SP 500 is held by the lower range of RTT steps. So we might see this recover where it is now. But what I wanted to highlight is that the SPY to TLT ratio is a measure of assets to debt. Now with RTT steps you can see the health of that trend, and it showed weakness in the last 12 months. See how this never broke the dotted line, but these stood. This goes to show how strong bonds performed relative to stocks. That means the bond market was correct. When everyone was down in the bond market, it actually meant the bond market did not lie, as it never has. Here's the Dow with RTT steps as reference. And also the dollar hasn't been, when the dollar is actually rising, it always forecasting some trouble. So this is the SPY divided ratio divided by TLT. It is a measure of how well the assets are supporting the debt of the US economy, and any divergence or strength of bonds relative to stocks has always forecasted trouble. But also must stress it also forecasts recovery. So if we want to be bullish and positive, we wish to see stocks start outperforming bonds. We wish to see it basing out and going higher, basing out and going higher. So as you can see, we probably have 6 to 12 months. I should draw it more correctly. That's better, isn't it? 6 to 12 months to find out whether the lows are in or some strength to come to the market, which is typical because at the moment we've had the shock volatility And when the results start getting reported, people are going to gauge, was this sell-off overdone, or is it just the beginning? And we must also understand the US government's printed $2 trillion and they expect further trillions of dollars to be printed. And with fractional lending, $2 trillion becomes $10 trillion pretty quickly. So that's a huge amount of money to burn on asset prices. So what that simply means is huge volatility. We may get a rally all the way back up here and then back down again. So the volatility in this market is going to be something we've never seen before. Well, I should say this generation has not seen before. So therefore, rushing to utilise cash in this market should be used with caution and wait till the volatility subsides. Thanks for watching. I just wanted to highlight how important the SPY TLT ratio was, as it is an asset to debt monitor. And if you wish to monitor how well the markets improve or fail to improve over the coming months, I encourage members to get the SPY TLT on your chart with the RT2 steps with the settings I have here, and watch it change and build and repair, or as we said, continue to show weakness. We're at the critical time now in the SP 500. This is the lower range. This is where markets hold. It started to hold here, but it failed there. Right? Held there, failed there. So we don't know what we hope to get some sort of bouncing activity, as we did in the previous two times, in 2001, 2 and 2007. Let's hope for that. Thanks for watching.